item number.
Well, I think the finance minister saved the best for the last, without doubt. On personal income taxation, there is a big announcement which has come. No income tax up to 12 lakh rupees under the new income tax regime. The entire slab structure itself has been changed. A new slab has been added as well. 1 or 2 new slabs have been added as well. And we'll have all of that up for you. Towards the end, the finance minister actually gave examples. She said that a person having an income of 18 lakh rupees per annum will get a relief of 70,000 rupees. And a person having an income of 25 lakh rupees will get a relief of 1.1 lakh in terms of their tax burden. So, I mean, that is essentially the announcement which the market has liked. On the macro big numbers, I'll touch to Lata in a bit, but, the 4.4% fiscal deficit target, which she said earlier, that remains. We are still, of course, waiting for the capex number for FY26, the budget estimate on capex for FY26. But she's managed to provide some relief to the income tax payer, middle class, right at the end. And I think, as you can see, the market reaction as well, there was a steep sell-off when she began, and she kept that fiscal deficit at 4.4%, dampening hopes about how much relief she can provide. But of course, towards the end, I mean, that personal income tax relief which she has provided for income of up to 12 lakh rupees exempt, I think that has provided a bit of cheer to the market as well. And the Nifty is back up a little bit, still down from where it was pre-budget, but we're down about 0.15. But I think this is a lot of taxation-related changes, both on the direct side and indirect side.
Finally,
well.
I think middle class
we have to reserve our judgment. We have to reserve our judgment because she gave us the net tax income for the government, and she said that that is going up from 25.47 trillion to 28.37 trillion, which is a rise of about 11%. So if you're cutting personal income tax and still this is up, we have to find out where
she's found the money.
There have been increases. As well, your expenditure has gone up by 7.4%. According to her, she mentioned total expenditure goes up from 47 trillion to 50.65 trillion. That's a rise of 7.4%. And you have got these tax reliefs. So is the capex budget cut? We will have to wait to see that.
She said 1 lakh crore is the tax foregone on direct taxes, and I think there was a number on indirect taxes as well.
Which I missed.
Towards the end, I think tax
she said
foregone
about tax foregone, but don't have the number. So my sense is maybe the capex budget has been
maybe it's a little subdued.
Has been subdued.
So it's finally a bonanza for the middle class, because after a long time, you've got big announcements coming in. And not just on personal income tax, some of the bigger demands of the tax world, they have also been addressed. Let's start with personal income tax. Now, these are the rates that I could pick up, and we're just cross-verifying all the slabs because the entire slab structure has changed in the new income tax regime. What's the first headline? The first headline is that there is nil tax payable up to an income of 12 lakh rupees. The first slab is not starting at 12, but because of the way the slabs have been structured and the rebates, you don't have to pay any tax up to an income of 12 lakh rupees. This figure was 7 lakh rupees up until yesterday. That is, I mean, we're talking about the previous budget up until FY25. So 7 lakhs was the limit of nil tax. Now 7 moves to 12. So that's a big boost. The slab 0 to 4 lakhs, 4 to 8 lakhs, 8 to 12 lakhs, 12 to 16 lakhs, 16 to 20. There is 20 to 24. And the 30% rate now comes in only above 24 lakh rupees. So there's a sort of a big boost coming in over there, and then the rates come in 5%, 12%, 15, 20, 25. So this is what we have. We're going to cross-check some of the figures there, but this is what was first glance, first hearing. This is what came out. So this is point number one. The second thing that a lot of homeowners will absolutely like to hear is that the second house property that you have, which was subject to easier taxation only if you complied with certain very stringent provisions. Those provisions are getting relaxed. So not just one, but now 2 self-occupied house properties will get a beneficial tax treatment. They will be treated as nil value from a tax perspective. So again, this is a big boost coming in for those women who do have 2 house properties. That's the other one. The third major sort of relaxation or rationalization has come in the TCS and TDS regime, something which the industry was asking for many years. And one of them, which I remember because there was such a furor around this earlier, is the remittances that happen through the LRS route, where the cap was 7 lakhs. If you were remitting money above 7 lakh rupees, then a TCS had to be paid. Now that limit has been increased to 10
10
lakhs.
lakhs.
So if Prashant and Lata are planning big foreign holidays with, big packaged holidays, then there is a bit of a TCS and cash flow relief comes in. But I think we have a panel of experts. Let's actually get to them.
That was anyway set off with TDS.
Yeah, but let's actually get to the tax experts. Ashok, let me ask you first. So big bang for the middle class finally?
Yeah, I'm glad at last. For years, middle class has been waiting to see whether they get real relief. And I think moving the slabs up is really very, very good. I'm not sure I heard it right, but my sense was that the 30% slab applies only above 30 lakhs. But I may be wrong.
Above 24.
What we heard was 24.
24 lakh.
Yeah. So I think at least up to 25 lakhs, it's serious relief. And she was computing the numbers and giving it to us. The question that Lata asked, which is a very relevant question, is that, if you're maintaining your fiscal deficit to the levels that you had announced, and you are foregoing 1 lakh crores in direct taxes, 2,600 crores in indirect taxes, and you are showing 11% increase in your tax collection, then where is the gap? We need to see the fine print to be able to see, where is the tax collection happening. But overall, I would say, from a middle class perspective, a fantastic budget, although corporates may be a little disappointed. There wasn't much that was at least spoken from a corporate tax perspective. But again, we'll have to look at the fine print.
Yeah, actually, on indirect tax, the amount foregone is only 2,600 crores.
Said right
so it's not a great deal.
If I can just ask Mr. Kanabar. Mr. Kanabar, you've been listening keenly as well. In the personal taxes, of course, is the big headline. But anything else you caught on the taxation front? Lots of announcements.
Actually, quite a bit, really. And sort of, just before the budget, we spoke about ease of compliance and quite a few things. Like, for example, there was this regarding safe harbor rules being extended. And of course, nobody cheered it up in the House of Parliament because this is not a subject which people would normally understand. But that's going to be something which will ease the compliance burden of multinationals, will promote a lot of foreign investment. Similarly, tonnage tax being applied to domestic vessels. Again, something very, very welcome. And then a few other things. So, for example, charity, if you are recognized, rather than renew every 5 years, you would renew every 10 years. You are permitted to update your return for 4 years. Each one of them may appear to be small things, but they were really irritants. And sort of their going out is going to be something which is very, very welcome. I think it's quite a bit really.
Well, that's the budget Nirmala Sitharaman has delivered, saving the best for the last. As we've been pointing out, this has been the big ask, the big expectation, the big hope, and the finance minister delivering. As the Prime Minister said, the focus this time around was going to be on the Madhyam Varg, or the middle class, and that is what the tax slabs that have been introduced in the budget have taken forward. So up to 12 lakh rupees, as we've been pointing out, no income tax is payable, and of course, new introduction as far as different slabs are concerned, and the 30% kicks in above 24 lakh rupees. But it's consumption that seems to have been the focus of this budget. We're still waiting for the fine print as far as the capex number is concerned. The revised estimate comes in at 10.18 lakh crore rupees. What is the BE? We need to know, but it is consumption that the government has gone for as part of what we are seeing. Let me very quickly bring in a take there from Madhu Kela. Madhu, FMCG stocks on fire at this point in time. It's a consumption boost that was being hoped for.
Yeah. Sunil, this is a big one. I think getting to 12 lakh rupees, I don't think anyone in the market was expecting this. So this is clearly a big one. And I have the capex number. It is 11.21 lakhs crores. So essentially, even the capex number are in line with what the market would have expected, from 10.2 to 11.21. And fiscal deficit, again, 4.4% next year. So I think they have met all the numbers which was guessed by the markets. I think it is on the better side only than what market would have assumed before the budget.
Okay, so 11.21 lakh crore rupees, that's the capex number, Madhukela, that you're giving us. That's coming in from the budget fine print. So as you're saying, the expectation was, or the hope was, between 12 and 14 lakh crore rupees. The government coming back with a number of 11.21 lakh crore rupees. So it is an improvement over what was the allocation last time around. Remember, 11.11 lakh crore rupees, so a slight improvement there, but an improvement over the RE. Disinvestment and monetization target has been kept at 47,000 crores for FY26. FY25 RE at 33,000 crores from 50,000 crores in B. Again, along expected lines, we've seen this happen on the disinvestment front time and time again, and that's what seems to have happened even as far as this year's budget is concerned. 11.2 lakh crores is the capex number. Very quickly, let me bring in our guest, Zia Mody. A quick take, the big headlines for you from Budget 2025.
Thank you. I think from my perspective, the now formalization of the insurance FDI to 100% is good news. What is even better news is the finance minister's commitment to revamp the KYC norms in 2025, which has caused a lot of pain in the ease of doing business. I think that the IBC, I was looking forward to some announcements on pre-packs or cross-border IBC situations. Maybe that will come later, but that is very important because that law has clearly brought down our NPAs. The enhancement of the judiciary, the dropping of government taking cases to court. Government today is our biggest litigator. Maybe there will be something in the fine print to show that unnecessary litigation can be cut down, especially since the FM has said she's digitizing faceless assessments, etc. I think that the one thing that stands out, which I'm hoping to see some movement from the government, is a liberalization of Press Note 3, which is the bordering countries, which has had a lot of unintended effects and slowed down FDI from private equity. But all in all, I think the message of getting out of the way, to stop micromanaging, to listen to the industry and to allow the theory of being honest unless you are proved dishonest, are all very, very positive messages.
Yes, positive messages. And speaking of positive messages, we're still going over the internals now, because remember, as the finance minister was pointing out, a lot of the details there in the annexure, not in the speech. More good news, the tax deduction limit for senior citizens has doubled from 50,000 rupees to 1 lakh rupees. So more sweeteners they're coming in. The tax deduction limit for senior citizens has been doubled from 50,000 rupees to 1 lakh rupees. We will have to wait to see under whether that's under Section 80D, but we'll get to that. Let me bring in our other guests as well. We've got plenty with us here. Before I get back, Madhu, a quick take on the markets from where we are before we get the other voices in.
Yeah. So, I think from a market perspective, I would like to mention one thing. There is a lot of emphasis on ease of doing business, decriminalization of laws, and making things really, really simple. Apart from increasing the personal taxation slab. One more thing, she spoke about the introduction of new income tax bill, which is to be tabled next week, and which will basically deregulate a lot of things. So this will be perceived very, very positively, and it's a basically continuation of the good effort. From a market perspective, shouldn't we are back to back to basics? I think this will be a range-bound market this year, and this will be stock pickers market. So if you can really take advantage of all this volatility which is there and pick up good companies, that's where money will be made.
I mean, absolutely. By the way, as you said, the volatility is back, right? We were up, we recovered after that personal income tax announcement. We're down about 50-60 points on the Nifty once again. Prashant Khemka is with us as well. Prashant, do you think this will, by the way, the Nifty FMCG index is up some 3%, Maruti is up 6%. More money in the hands of the middle class. Where will they spend it, in your assessment? And as a money manager, what looks best placed?
See, I think overall it is positive for the market. As Madhu just pointed out, the most important thing to me is that there's a genuine intent and effort. It comes through very clearly to increase the ease of doing business. So it's directionally very positive. There's no material negative. I usually, when I'm sitting and hearing the budget, I keep tab of the positive snippets and negative, and there are hardly any on the negative side. Whereas on the ease of doing business, the underlying spirit of the budget is to simplify rather than to complicate things, which is often the problem with budgetary speeches. So be it 100% FDI in insurance, simplifying TCS, TDS, or decriminalizing additional 100 laws, safe harbor rules, as mentioned earlier by Mr. Kanabar, I believe. So a lot of the, obviously, fine print needs to be still seen, but all sounds very positive. And most importantly, the finance minister mentioned the new income tax bill, which is scheduled for next week, would be, in her words, it would be clear, simple to understand, and provide tax clarity. That would be a big boost to overall business environment, and that can only be positive for job creation as well as for the markets, broader market. So if there is additional savings in the pockets of middle class, I think the market, rather than selecting a particular sector, I think it should be positive for the broader Indian market.
Okay, gentlemen, I just want to come to a couple of additional announcements that we haven't heard so far. They're all from the budget documents, and these are perhaps going to be very welcome by the financial services sector, and I'll get to the experts in just a bit. For GIFT City, there is a boost. It is proposed that transfer of share of unit or interest held by a shareholder in the original fund in consideration for the share or unit or interest in a resultant fund on relocation shall not be regarded as a transfer for the purpose of calculating capital gains. There was an ask that if a fund or a structure is relocating from a foreign destination to IFSC GIFT City, then give it some tax relief from the point of view of capital gains, and that seems to have come through. And one more, the extension of the date for sovereign wealth funds that are investing in the India infrastructure sector. There was a sunset, but now look at the extension. Instead of March 2025, they have extended it all the way to 31st of March 2030 to attract long-term capital in the infrastructure sector, perhaps. So if I could go back to the panel, Mr. Kanabar, your thoughts on some of these internals that are arising from the next years?
Both of them very, very welcome. This
Absolutely.
was something, a very, very specific ask.
Yeah.
Clearly, investment into infrastructure is something which is long gestation. There is no point in tinkering it year on year on year, and giving it a 5-year thing is something which is very much welcome. Similarly, the proposition is that if there are funds with investments in India and they are relocating into the GIFT City, then there should not be a tax implication. Again, that has been accepted. Both very, very welcome. Similarly, there is this whole provision that if your transfer pricing is accepted, it is accepted for a block of 3 years. Again, will make not a lot of non-residents relocate India and come back to say the transfer pricing litigation will come down. All very, very welcome.
Okay. No, that's good to hear. Actually, I have some problem perhaps with the confidence. Corporate tax growth, according to the BE for the current year, works out to 7.5% higher. For next year, the estimate is that it will rise by 10.5%. So we keep our fingers crossed over there. One expects that corporate sector has to do better, but obviously that is the estimation. But otherwise, the estimations are very modest. For instance, income tax this year, it is up by 22% as of December, for which we have data. They have estimated only 20% higher for the full year. But for next year, the estimate is only 14.4, clearly because tax rates have come down. So the estimates seem modest when it comes to income tax. Corporate income tax, I hope we deliver on that 10.5. But I think within this, in spite of not assuming very aggressively, they have been able to give a capex of up by about 10%. So that's very good. Prashant, can you tell me why the market is sulking? It's got its tax cuts. It's got nothing negative in terms of capital gains. But actually, there's red on the screen. Bank Nifty is down about 0.5%, 0.6. Anything that's niggling the markets at all, Prashant? And then I'll come to Madhu Kela on that.
See, hard to say with markets 0.5% here or there. But if it was me, I would read this as a positive. And I would think if I had not seen the market ticker, I would have expected the market to be positive today by a percentage point at least, because the absence of any negative itself is a big positive. And then, as we were talking earlier, there are a lot of, absent the fine print, still a lot of directionally very positive announcements. The 100% to FDI, 74 to 100%. In and of itself, none of these measures may be big enough to have a positive impact. But when you view them collectively, it shows the direction in which the government wants to take it.
Actually, it's I think the defense stocks and the railway stocks that are going down, because I guess something specific was expected on defense. But otherwise, FMCG stocks, consumption stocks, all the trends, the Britannias, the auto stocks, Bajaj Auto, all of them are up and about. Maruti Suzuki's numbers also have been good for December. Mr. Dinesh Khara is also with us, former chairman of State Bank of India. Mr. Khara, the borrowing has been kept almost as expected. It's about 14.8 trillion. I think the market expectation was 14.5, but the fiscal deficit is lower than expected at 4.4%. What do you think you can expect? Rate cuts now, good times for banks?
I think it may or may not have any impact on the rate cut, but yes, it certainly reflects that what is the government thinking. And so long as fiscal is kept within check, certainly it is an indication that inflation will also remain under check. That is what I would like to add. And also I would like to mention, when it comes to various sectors, particularly what is talked about in terms of the income tax, personal income tax, it is going to spare a lot of liquidity with the middle class, which will certainly spend. Likewise, when it comes to agriculture also, the KCC limit has been increased. Similarly, when it comes to MSME also, they have increased the guarantee cover. And similarly for the exports. So I think these are some of the sectors which are eventually going to have the mainstay when it comes to the economy.
Right.
So I think on these very parameters, it really augurs very well when it comes to the economy overall. And the kind of challenges which we faced in the last quarter numbers, they are very well being addressed through this budget.
Got it.
The point
Sajjid
taken about MSMEs, I think what the chairman is pointing out is very well taken.
Sajjid is with us as well. He was with us right before the budget speech started. Sajjid, what did you make of the big macro numbers? All in line?
Very much in line, right? This is following the rhyme and rhythm of previous budgets. I think conservatism was the buzzword here. The deficit number is very similar to what we thought. 4.8 goes to 4.4. Nominal GDP assumed quite conservatively at 10.1%, to this year is below 10. And the question was, and we had also said that capex to GDP would remain in line with what is achieved this year, and that's panned out as well. Capex is rising in line with nominal GDP. I guess the question was always, where was the consolidation going to be achieved? Would it be on the revenue side or the expenditure side? It's largely on the expenditure side, and it's happening on non-capex expenditure. So there's some expenditure restraint on revenue expenditures. The other one point to keep in mind is on tax buoyancy. Once you adjust for the foregone revenues from the tax cuts, the budget essentially is assuming a tax buoyancy of 1.3. Okay. Now, this year we got about 1.1. So we'll wait to see if that's achieved. But I think no major surprises as far as the big fiscal math is concerned.
You know, the GTR, gross tax revenue, is assumed to rise by 10.8%. And nominal GDP by 10.1%. So it doesn't look like it's...
No, well, because, Lata, you have to adjust for the foregone tax revenue, which is 1 lakh crore from the tax cuts.
Yeah.
So when you adjust for the foregone revenue, then what you're assuming is the effective growth in gross taxes is 13% in a nominal GDP of 10.1.
Okay. Well, we have Anish Shah also with us. Mr. Shah, what have you made? The auto stocks are up and about.
One is a demand stimulus that was much needed and very well delivered. Second, a focus on making India the manufacturing hub of the world. The focus on ease of doing business, on enabling capital goods to be imported at lower rates, and importantly, addressing the duty inversion that we've seen. These are all things that will help make in India in a much more significant way. And the third is inclusive development, which is also something that is important for us as an economy. So on balance, a very good budget, The capex from a government standpoint stays on course, which is something that we ideally would have liked. And the fiscal discipline stays on course as well.
Well, that's right. The fiscal discipline stays on course. Capex, along what clearly what the economic survey as well as the CA were highlighting would be the trend as far as capex was concerned. But then you can't have capex and the consumption boost at the same time. So the expectation of doing 20-25% on capex and then also providing income tax relief, which has been the big focus of this budget, can the two be reconciled together is the big question. So the government this time around has prioritized consumption and relief for the middle class. And if you just bring up all of those stocks, FMCG stocks at this point in time, the new age stocks, Zomato and Swiggy and all of the others, and Mangalam is standing by with a rundown of everything that's moving. That side of the market clearly is firing at this point. But let me bring back our budget editors into the conversation as well, Atanu Chakrabarti and Rathin Roy. Mr. Chakrabarti, to you first. As far as the big numbers were concerned, pretty much steady as you go.
Yes, very much in a sense that the borrowing numbers satisfy the requirement of, I was looking in containment, they have actually gone in for reduction. So even if numbers don't hold at the end of the year, still the borrowing numbers, the gross borrowing numbers are lower than last year, assuming a fiscal deficit at 4.4%. Yeah. RE is at 4.8%. So a good glide path there. Consumption, Philip, given through, as you just mentioned.
Were you expecting them to go as far as they have? Or has it surprised you on the positive side?
Frankly, no. I am pleasantly surprised and very happy about it that the fiscal reduction, debt reduction is, because that opens up the credit growth for the industry in general, which has been sort of accounted for in a lot of expenditure proposals. They're depending upon bankable schemes. Right. So unless you open up that space and crowd out, you are not going to get that. So there is, I can see a design in the entire thing, that fiscal reduction, which was important, and that builds upon a lot of bankable schemes that have come.
So Rathin Roy, they have delivered on the 3 C's that we were talking about. Capex, you can argue about whether they could have done more, but more importantly on consumption, they've clearly delivered more than what the market or even the consumer was hoping for. And even on consolidation, they've stuck to the glide path.
Yeah, well, I was not expecting them to not stick to the glide path. I was not at all sure whether the government would engage in yet another round of wishful thinking. Quite frankly, I think the execution capabilities of this government, as far as capex is concerned, has hit its limits at 11 to 12 lakh crores. Now, the point is to try and promote capex in the private sector, where the real execution capability is. Looks like this is what the government has in mind. Yeah. But I'd like to puncture one balloon. Everyone here that's come on your program so far, me included, is in the top tax bracket. And everyone who pays tax in India is in the very rich part of the population. It is facile to call them middle class. So what has happened is, at the cost of 1 lakh crores to the exchequer, which is a small price to pay, is a major increase in the regressivity of our income tax system. Till yesterday, you had to earn 3.5 times the per capita income to start paying income tax. You will now have to earn 6 times the per capita income, 6 times the per capita income to start paying income tax. So by no stretch of the imagination can we say that these people who begin to pay income tax at 6 times the per capita income belong to anything other than the top 5 or 10% of the population. So that regressivity has come at what cost? Well, it has come at, the tax system has become more regressive because if you look at the indirect tax burden, it's the same. So you have the progressive part of the tax system, which is direct taxes, is now nicer to the rich people. The indirect taxes, where the burden is shared between rich and poor, remains high. And therefore, what ends up is the proportion of taxes relatively poor people who don't pay income taxes but do pay indirect taxes is now greater. So this is, in that sense, on the tax side, a regressive budget. It will increase consumption of you and me. It is going to do nothing, absolutely nothing, for consumption of the Aam Aadmi.
Okay. Well, we'll have to wait to see, but the market reaction at this point in time is 2 thumbs up. Manglam, very quickly, run us through what's happening on that side.
Well, you know, it is a consumption budget, Shireen. Tell you, no income tax payable up to 12 lakh rupees, income of, you know, up to 18 lakh rupees, saving 70,000 rupees, and income of up to 25 lakh rupees will save over 1.1 lakh in taxes. What does this do? A shot in the arm for all the urban consumption names. So we have, you know, names like Jubilant Foodworks, Zomato, Trent, D-Mart, the ones who have a higher propensity of revenue coming in from the urban centers doing extremely well. No tinkering on taxes for you know, all the sin goods. Those stocks also doing extremely well, and some support coming into rural and agri names has a you know, positive impact on larger FMCG names as well. The FMCG index had been underperforming. The street was hoping for some sort of shot in the arm coming in from the budget to consumption. The government has gone ahead and made its 2 steps. Now the rest remains on the FMCG industry to go ahead and deliver those growth numbers. Most of these stocks are actually trading very close to their 10-year averages as well. So from a valuation standpoint as well, this budget has a trifecta of all positive news coming in from the consumption sector. And we're seeing that in names like Jubilant Food, Trend, ITC, all of them being among the top gainers in today's trading session.
They certainly are, but let me go back to Anish before I let him go. Anish, you know, in what way does what has been delivered today change the needle? Do you believe, as far as private investment is concerned, that's been the big hope and the big ask in terms of consumption as well? And also from a manufacturing standpoint, the measures announced by the budget, including on the customs side, on each of these 3-pronged areas, how does the needle move post the budget?
I think it just accelerates our pace, Shireen, because the fundamentals have been very strong in the economy. We've seen short-term blip from a demand standpoint. With the consumption incentives given here, hopefully that is addressed. The more important thing is to ensure that we can manufacture in India at a much lower cost than the rest of the world. And that will allow the economy to grow at a much faster pace. And a number of measures taken here are steps in the right direction to make that happen.
Okay, got that point, Anish. By the way, I just want to point out, trying to go through more and more of the annexures. So while the budget speech spoke about the reduction in TDS thresholds for certain segments, for instance, the LRS limit 7 going to 10 lakhs, there is an increase in TDS rates or the thresholds for a whole range of payments. Dividends for an individual shareholder, income in respect of a mutual fund from a specified company undertaking, winnings from lottery, crossword puzzle, winnings from horse races. So there are several cases where the thresholds have been increased. So that's what we have at this point in time. I just want to go back to the panel here and, Sunil, if I could come to you, what is the big picture takeaway? The headline clearly seems to be that the middle class has finally gotten the relief. But one ask, at least I have not found even in the fine print so far, which is corporate India was asking that new manufacturing companies should be given more relief, that concessional income tax rate of 15% should be brought back, if not 15, 18%. But as of now, we've not seen evidence of that in the speech or in the documents. Your overall take on what this will mean once we go beyond the personal income tax bonanza?
So thank you for having me. So I think, Surbi, a lot of eyeballs and discussions is obviously pertaining to the income tax relief, and rightly so. The government has given 1 lakh crore in the hands of crores of Indians, and that is a welcome step because I think the economy was suffering from low consumption, a combination of obviously maybe less disposable income as well as tight liquidity situations. So the liquidity situation was eased off a little bit 3-4 days back when the central bank pumped in 1.5 lakh crore, and now this 1 lakh crore additional also has the potential of at least kickstarting a little bit of a temporary blip in consumption. Having said that, I think capital expenditure, which was slated to be 11 lakh crores, the government has not been able to spend the entire amount, maybe because of inflation, everything got deferred. And to that extent, the kickstart as far as capex is concerned has got deferred a little bit. Luckily for next year, we are again looking at a 10% growth on this lower 10 lakh number. And I think that is something which is very interesting and is very, very needed. As far as your comments are concerned, I think a lot of announcements were made in terms of, pushing manufacturing in India, particularly, industries where it's more smaller industries, SMEs, where there are a lot of imports, a lot of manpower required, like textiles or leather or toys and so on and so forth. So I think the intent is very clear that we need to make India a powerhouse in terms of manufacturing also. We still have to see the fine print, but on the face of it, obviously this 15% has not been revised. But on the infra side, I think there has been a 5-year extension in terms of fresh investment, which will
absolutely
be
the sovereign wealth funds.
Benefit. So I think it's a good balance. I think overall, it's a very balanced budget. I wouldn't say it's like a superlative growth-focused budget, but this 1 lakh crore of added income in the hands of crores of Indians, I think that's a key positive.
Yeah, absolutely. And I just want to add to that the annexures show a whole range of announcements to make GIFT City more attractive. Again, that's a stated roadmap to try and get in more longer-term capital through that route. In fact, let me answer, and one more point we should keep in mind on crypto, by the way, there is a clear reporting framework that has been announced. It says there is a proposal to bring an amendment in the Act for this new reporting framework for all regulated entities, which would be crypto exchanges. They have to give information on digital virtual assets in a specified format as the government asks for it. So that's one. But coming on this point, if I could throw this to Ashok and maybe to Dinesh as well. Ashok, coming to you first. While, visibly we don't have that headline on 15% tax for new manufacturing companies, I don't know if you had a chance to go through some of the GIFT City provisions or the other provisions, sovereign wealth funds we've spoken about. Do you find anything else there that could excite longer-term investors looking at India?
I'm actually just looking at the fine print. It's just been delivered to me. And there does not seem to be anything which is specific. I mean, obviously, we've all spoken about the infrastructure. We've all spoken about the one question that's still unclear is that if a domestic fund, in other words, if a fund from India was to relocate to the GIFT City versus a global fund being relocated to GIFT City, whether the relocation from India to GIFT City also triggers the same benefit or not. That's not been clarified in my view. Where there's clarity about global funds being relocated to GIFT City, there is clarity.
Yeah.
I haven't been able to pick up whether, if for example, a normal fund, an AIF was to decide to relocate to GIFT City, whether that capital gains would be exempted or not. I haven't got that done. But there is language around parity on long-term capital gains on transfer of securities between residents and non-residents. And there was some lack of parity when changes were made last year, both in terms of property as well as, of course, in securities. And I think they seem to have brought that parity back. That certainly seems to have been provided as a clarification. But over to Dinesh for that.
I just wanted to come in with some of the sectoral outlays, guys, and maybe we should just bring up these numbers for the benefit of all of our viewers. The defense sector outlay has seen a reduction at 4.91 lakh crore rupees. The budget has allocated 4.9 lakh rupees for the defense ministry. That's down from 6.2 lakh crores in the July 2024 budget. So that's as far as the defense allocation is concerned. At 4.9 lakh rupees for defense, down from 6.2 lakh crores in the July 2024 budget. Rural development, an outlay of 2.6 lakh crore rupees. Agriculture, 1.7 lakh crores. Education, 1.28 lakh crore rupees. Health, 98,311 crores. Urban development, 96,777 crores. IT and telecom, 95,298 crores. We'd have to also see whether there is an enhancement or a reduction across, but defense, there is clearly a curtailment as far as the outlay is concerned at 4.91 lakh crore rupees versus the 6.2 lakh crores. You wanted to come in, Ratin?
No, I just wanted to say that one good thing in this suit boot budget, which should help all the suit boots who are celebrating this so-called middle-class tax cut, is a very promising announcement the finance minister made, that she's going to cut the tax code in half. That's been long overdue, long overdue. And much as I might be, sad at the celebration that's going on about this, people earning 6 times the per capita income getting a tax break, lowering the tax code bill, I think, should incentivize the growth in taxation. I also want to caution about the numbers for next year. The implicit buoyancy of 1.3, 1.4 that is implied in this budget is very rarely achieved by government, especially at a time when growth is tanking. So this particular cut, although the absolute amount is only 1 lakh crores, might actually put pressure on government outlays. On defense, I want to say, I think the government has been very realistic. They're unable to spend on defense. So there's no point allocating money for defense when you can't spend any money. And I think the government has done quite the right thing to make it more realistic for next year, because they have a good idea about how they're going to be able to allocate money to defense next year. So all in all, I think on the expenditure side, the budget has been prudent, and therefore you're seeing more modest outlays, because the execution capability of the government is limited. And it is for that reason, and not because of the tax cuts, that the expenditure side looks, moderate.
Fair point, and that's an interesting and important point that you make as far as the defense sector allocation is concerned. Mr. Chakrabarti, you've been going over the fine print. Anything there, and especially as far as the housing sector, etc., is concerned, cement, steel, what do you believe that the budget does in terms of infrastructure, housing specifically?
Three things. For defense first, I guess we need to, because these are reasonably finely balanced. So perhaps we have to see between the revenue allocation, because revenue was about 3 lakh crores, balance about, so it was about 4 point odd something.
Right.
So I'm a bit surprised when we say 6, because there are some other allocation for roads, etc., which keep changing. So I guess a fine print needs to be seen. This is unlikely. There's not much of a scope for cutting, because almost 75% of the capital acquisition in any case is domestic.
Correct.
So therefore, the numbers are reasonably well known. So that's one particular thing I'm happy about is about IFSC, which we just discussed.
The gift city,
A, income tax, B, getting AIFs in. Because if you see, the corporate tax is at 9.8% growth. Less than 10.8% envisaged, 9.8 lakh crore, about 40,000 crore less than what was envisaged at B stage. It has not really kept up pace. So the only disruptors in the economy are going to be the startups and GCCs, where there's a lot of private equity movement, which could happen only through IFSC. To that extent, one again has to see the fine print of regulation and everything, but at least a correct direction on the things to come.
Correct direction, and of course, as we've been pointing out, we are poring over the fine print at this point in time, because the speech did not focus on the details which are available in the annexures. But let me toss it back to you in Bombay.
Shireen, thanks very much for that. I'm just looking at the market, and I don't want to sort of put everything which is happening on the budget. I mean, after all, it's for Saturday as well. So we must keep that in mind. But FMCG, of course, the index is up almost 4% now. So if anything, it's picked up a little bit more steam. And the auto space is up about 2% as well. On the other side, defense, as you said, Shireen, in terms of allocation, sharp deceleration, right? The index is now, there's a nifty defense index, it's down 3%. And the PSC, CPSC, a couple of these government company indices, oil and gas, they're all down between 2 and 3% at this point. The metals index is down about 1.8% as well. And IT as an index is down about 1.5% as well. I just want to go back to Sunil for a bit. Sunil, with this sort of 1 lakh crore boost to the, the taxpayers, as an investor, does it make you any more bullish directionally to look at that area? There is on this Friday, we'll have something from the RBI as well, maybe a rate cut.
So I think, Prashant, last 1.5 years, consumption generally has been pretty slow. Combination of maybe a little bit of inflation, maybe a little bit of fatigue post the huge boom we saw in the consumption post COVID and so on and so forth. I think a little bit of liquidity squeeze also from NBFCs and banks in particular post the regulator directing them. So I think all this is getting sorted to some extent. On the fundamental side, we have had good monsoon season, good crops. I think crop prices are good. So the rural income should be pretty handsome or should see a pretty handsome growth. You had RBI, which infused 1.5 lakh crore only a few days back. So liquidity has been to some extent taken care of. And now we have this huge boost of 1 lakh crore flowing into the hands of Indian consumers. So I think at the margin, obviously, yes, there will be some move up as far as consumption is concerned. However, what is happening on the consumption stocks is a combination of a lot of things. One is they have never been cheap. They are not cheap. So there's a valuation headwind. Second, there are a slew of new products coming in, and particularly with this advent of digital economy and D2C brands and so on and so forth. To some extent, there's been a cannibalization, even in terms of existing players losing some market share. So I would say that at the margin, this is positive, but this is not something which would lead, an investor to double or triple the weightage as far as consumption is concerned. Maybe, a slight tweak, but for the economy, I would say it's a bigger boost because the economy needs consumption as well as capex to move back to that 6.5–7% nominal and real and 10% nominal growth rate. Rate cut, I'm not sure whether it's going to happen very soon, but the good thing is the path to fiscal prudence is maintained. And to that extent, the environment as far as interest rates in India is concerned is pretty, on the downside, which is refreshing compared to what is happening in the world.
Okay. Well, point taken on the consumption boost, and I also take Ratin Roy's point that that also means that there is that much less in terms of welfare expenditure. You cannot take away from the fact that we have a very large number of people who are not earning even 6 lakhs, forget 12 lakhs a year. But Mr. Dinesh Khara, to come back to the fact that there is more money in the hands of those who would take retail loans. 12 lakh rupees is the minimum income tax limit now. Does this mean that banks can now have more of a retail loan, or do you see the capex baton being picked up at all by private sector, given what the budget has said?
No, I think there is a very clear focus when it comes to the infrastructure investment, and also they have brought in the PPP concept also. So I think part of the infrastructure also, they have also indicated that even state government are expected to join them in this PPP investment for the infrastructure. So I think infrastructure boost will certainly be seen. And when it comes to the retail borrowing, maybe, there are, of course, when it comes to the consumer unsecured borrowing, that is expected to remain expensive. But nevertheless, I think as far as home loan, etc. are concerned, there will be enough disposable income to support the EMI. I expect that even that sector will get a boost with this kind of a income tax relief which is seen. And also I would like to mention that, now the startup also, they have increased the guarantee scheme for startup as well. So I think to that extent, they are addressing all the very critical components which are required to be addressed for giving the required push to the economy.
All right, okay. Got that point, Mr. Khara. Just going back to Dinesh. Dinesh, earlier, I asked that question to Ashok as well. Let me take that to you now. Whether there is anything further that you've picked up in the annexures in the fine print. There are lots and lots of announcements on GIFT. One, we discussed, but like Ashok was saying, that there still needs to be clarity whether there is a domestic relocation from, anywhere in India to GIFT, whether that also gets a capital gains exemption. Anything else which could boost investments and flows?
Lots and lots of things. So far as GIFT City is concerned, income arising by way of ship leasing is specifically exempt now. ETFs have been brought under the ambit of what can be done in the GIFT City. One very welcome thing which one has seen this time is that most of the extensions are for a period of 5 years rather than 1 year, which you see at a time. So for example, the income of a startup is exempt for a further period of 5 years straight away. So up to 30, whatever startups are there, 5 years exempt, which is again a very, very welcome thing. One very interesting change, and the finance minister did mention this in her speech, but I didn't pick it up at that point of time. There is this concept under Income Tax Act that if a foreign company has a significant economic presence in India, then it is liable to tax in India. This, of course, applies where there is no tax treaty. And the question is that if the significant economic presence is only for the limited purpose of export, would there be a tax liability? And that has been clarified, and that should provide a relief to several people, because that was something which was acting as a barrier to exports. So again, very, very welcome. So quite a few clarifications out there.
All right, Mr. Kanabar, we'll come back to you, sir. Let me bring in Amitabh Kant. He joins us now. Mr. Kant, always a pleasure. Many thanks for joining us here on CNBC TV18.